Hi, everyone. This is Tim with Safe Money Retirement, founder and broker here. I get a lot of questions about how these safe money retirement products work. So this brief video is just kind of an overview, kind of at 10,000 feet of how these products work and how they might be able to work for you in your situation. So when you're looking at a safe money retirement type product, there's basically two directions you can go. Directions number one is a guaranteed lifetime income product. So there are products out there very much like pensions used to be, where you can put in a set amount of money and either starting immediately, or you can what they call defer for a certain number of years. During those years, we can set it up to where that money has growth with no chance of losses based on what a market index does, or we can tie it to a guaranteed what they call roll-up rate that will get you a guaranteed rate of return for a certain number of years. So let's say you're 59 and a half, so you can get to your retirement account. You could move that, delay it for 5 years, let it grow. Right now, there's a product out there. Now, this is subject to change at any time. There's the disclaimer. But right now, there's a product out there that's going to give you a 7% guaranteed roll-up for every year that you defer. So then in 5 years, it would have grown at 7% per year, and that's what your income would be based on. So that's one direction. That's a guaranteed income plan. It can start immediately, or you can defer it. And then there's multiple options that we would figure out what you wanted to do if you did defer it. Now, the second type of plan is a growth with no losses plan. Now, a lot of these plans, some of them really don't, but most of them have some type of an income component. Some of them you can turn into a guaranteed lifetime income in the future, or some of them you can just withdraw either 5 or 10% of your account balance every year and take your income that way. But here's what I want to show you. I created a quick PowerPoint that explains how these point-to-point products work. And it's very quick to go through, and it really helps people understand what it is that I'm talking about. So what you're looking at right here, this is the actual S&P index, the ticker from January 2000 to January 2013. You can look it up. That's exactly what it did. Now, here's how these products work. These are point-to-point index crediting products. So these are the growth with no losses. Here's how they work. What we're going to do is we're going to assume that you started right here where this red star is in 2001, and we're just going to make it easy and say you had $100,000, and that's the green smiley guy right here. Now, the way these products work is they are point to point. So as I'm recording this, it's March 1st. If you were to start an account today, the company wouldn't even look at your account until March 1st of next year. At that point, one of only two things is going to happen. There's only two options. Option number one, which is what happens here in this first, is during that year, the index that you're tied to went down. When that happens, you don't lose a penny because these are index crediting strategies. You're not actually in the market, so you don't ever have any losses. Also, just so you know, there's a lot of these type of products that have no fees either. There are some that do, but if you do have a fee, it's because you're paying for a higher participation rate, and I'm going to explain that here in just a second. So let's go ahead and move forward to the next year from 02 to 03. As you can see, it went down even further. Everyone's freaking out once again, but you are staying right where you are with your 100,000. You don't lose a penny. Now, here's the secret sauce to these things is, once again, they're just point to point. Doesn't matter what happened back here. Doesn't matter what's going to happen over here. It's looking point to point, point to point. Option number two. Option one was if it's down, you stay where you are. Option two, if it's up, you get a percentage of those gains. And that percentage is going to vary widely based on your parameters and what you're looking to do and what company and what index. And there's a bunch of different variables. But needless to say, you'll get a percentage of the gains. And that's what happens here. So while everyone else is down here, just glad that they're starting to make back some of their losses, you haven't lost anything, and now you've got a percentage of the gains. And every single year that there are gains, you get a percentage of those gains. Then 09 happened. We all remember that. Wasn't fun. Everyone's freaking out even more now. You remember I've got a lot of clients that lost well over half of their wealth during this little span of a year and a half. Once again, you stay right where you are. There's no losses. You don't even go back to your original. Every time that you get credited, you're locked in, and it's never going to be below that unless you take money out. And once again, it's point to point. So it doesn't matter that it went down here before it went back up. It's looking point to point, point to point. It's up. So you get a percentage of those gains. Every time that it's up, you get a percentage of those gains, which is locking your principal in and keeping your principal 100% safe. So that's how those products work. And that's really the two different options. And that's one of the first things that we'll discuss after we start going through and figuring out what it is that you're looking to do. Are you looking for a guaranteed income, or are you looking just to continue to grow, take out income when you want to, but just let it grow? Or it could be a mix of the two. You know, if you had 300,000, you might want to do 120 in one and, you know, the other 180 in the other. So, I mean, we can fix it however is going to be the best for you. So I hope that helped a little bit, and look forward to talking to everyone soon. Just get with me. I'll be happy to answer any other questions, and we'll talk to you soon. Take care. Bye-bye.